Today, I'm chatting to PSG Asset Management CEO Anet Ahern, and we're considering some of the most important factors that investors should consider when structuring their portfolios. So, Anet, I think a key tripping point for many investors is considering the balance between risk assets and cash in their portfolios. And do they actually need both?
You absolutely need both. So if you look at your portfolio, it should do something for every aspect of your investment. So every type of investment has a trade-off. So for instance, cash will give you safety, easy access. It'll give you a little bit of interest that it'll pay every month or every year, but it's not really going to give you growth. So in your fight against inflation, in other words, the biggest thing all of us want to do with our assets is to grow ahead of inflation and not lose money. Those two things you have to balance. So cash will help you not to lose money, but it will not help you to grow your assets. However, if you go to equities, whether it's local or offshore equities, that has the most power to give you inflation-beating growth over time. But the trade-off is that in the short term, it can be quite volatile and can be influenced by emotions and sentiment in the environment. And in the middle, we have the longer dated bonds, which at the moment can probably do a bit of both. The rates are quite high because people are concerned, so you get a high interest rates well above inflation, unlike cash. But at the same time, it can be a little bit more volatile as well. So all three of those big building blocks need a place in your portfolio. And then the fourth one that's very familiar to most investments, of course, is property, listed or otherwise. Now let's talk about unlisted property because most of us have exposure to that. The biggest problem, of course, with unlisted property is that it's not so easy to sell. So you can't get your money tomorrow. You can't get your money in a week's time. So every investment has its role and every investment has its risks that you have to manage.
So, Anet, you've been in the markets for a long time and you've probably seen it all. When it comes to some of the most common pitfalls that investors experience when it comes to structuring their portfolios, that ultimately causes them not to meet or attain those goals that they set out to achieve, what are those? And how should investors be thinking about this, considering the bigger picture?
The three main things that investors do that sabotage them. The one is thinking short term. The second one is making an emotional decision. And the third one is not having a plan. So if we look at your financial well-being and we compare that to your physical well-being, to be physically well, you need to have a balance of good nutrition, you need to have some kind of exercise program, and you need to get enough rest. Those are basically the things. And of course, you have to have your checkups. So if we compare that to financial well-being, if you are on a good program physically, you can fall off the wagon every now and then. You can stress eat. You can have a party every now and then, but you can't consistently break your plan. You can't consistently break your process. So if you compare that to financial well-being, you need to have a plan in place, you need to have a good distribution of assets, and you need to be able to think long-term and be consistent about how you apply that plan in practice. You can't constantly overspend. You can't constantly change your portfolio from growth assets to cash just because you're scared in the short term. That's going to sabotage you in the long run. So it's really about getting a structure in place and applying the guidelines that you've set for yourself or with your advisor consistently over a very long period of time and not being caught in an emotional short-term decision.
So the investment landscape can sometimes be a bit overwhelming. What should investors consider when they look at which fund manager to include in their portfolios?
Good point, Audrey. There are many funds to choose from and many fund management companies to choose from. So I think one of the first things to look at would be the parentage, the reputation of the holding company of the investment team that you hope to trust your money to. So I think looking for a company with a good, solid, long-term track record, the range of products that you actually need. They've been around for a while, they're likely to be around, and they've got a good reputation. So once you've done that, you need to look for the capability in the particular part of your portfolio that you're looking for. So you're going to go to income funds, to people who've got a good fixed income team, same with equities and with global. And of course, when you get those lovely multi-asset solutions that capture a whole lot of things in one, very, very nice for retirement fund money, Regulation 28 money, then you're looking for someone who can actually manage multi-asset portfolios. So they would have to have an extensive team with track records across income, global and local. And I think that would be your starting point. And then I think when it comes to structuring your portfolio yourself, there are lots of tools available to do it yourself, but you can also obviously go to an advisor. And we're very fortunate in South Africa, the quality of our advisors is generally quite high, and we operate in a very well-regulated financial services industry.
Anet, to bring it all together for us, are there any pointers or tips that you can offer investors when it comes to structuring their portfolios?
The biggest thing is that you've got to put a long-term plan in place that is correct within your own risk profile. And don't underestimate how much you need growth assets. You need to beat inflation. Many people are not well enough provided for when they retire. And the way to get to that goal is to have growth assets and to have a plan in place that you apply consistently. You can't chop and change. And that is probably the biggest pitfall, and the biggest, if there's such a thing, biggest tip I can give people is don't chop and change. Put a plan in place and stick to it.
Anet, it's been great chatting to you today. Thank you so much for making the time to take us through the basics of investment.
Thank you so much for having me.